What's up, Finlit Live family? It's your favorite insurance agent, DarnaldJr. And have you ever been told you should invest your money? And you're like, okay, what do I invest it in? And you hear a lot about stocks, but you don't know exactly what a stock is. Today, we are going to be covering the basics as far as what are stocks and how to get started. So without any further ado, let's go ahead and get lit. All right, I hope you have an amazing Tuesday wherever you are in the world today. And today is a very, very exciting topic because it's something that everybody hears about, but not everybody knows exactly what it is. And so, for me, just to give you my backstory as far as my experience with stocks, first of all, I would like to start off with some disclaimers. I'm not a stock advisor, I'm not a broker. I'm not any of those things. Today is going to be purely educational so you can know the basics as far as what a stock is. So if you choose to invest your money into a stock, you know exactly what you're doing and you'll have the foundation, because you could get into a lot of weeds with stock market investing because there's a lot of nitty-gritty details that you could go into stocks. But this is not that video. This is going to be a broad overview. I'm going to teach you a couple of concepts and see how you could get started in the stock market if that's something that you want to do. So first of all, let me tell you my backstory as far as my experience with learning about stocks in the stock market. Obviously, I'm an insurance agent, so that's not my expertise, but my experience actually started in middle school. I always claimed that school didn't teach you financial literacy. This is one aspect of financial literacy that I actually did get in middle school, and it was because I was part of Encounters, which was a gifted and talented program. And it's something that my gifted and talented teacher wanted to teach us. And we actually worked with the stock market throughout the whole year. And this was in middle school, believe it or not. So she actually gave us the foundation as far as what stocks are. We actually did fake trading, where you paper trade is where you just make up numbers and you track that stock to see if you actually made money or lost money. And so it was really, really exciting. I look forward to that class. And it was unfortunate that the education for my financial literacy personally ended there. In high school, they didn't teach anything about stocks or anything along those lines. And so that was my only experience actually in school learning about the stock market. But the nice part, fast forward, is I got into a class that I paid quite a bit of money where I actually learned how to do stock options. And we're going to talk about stock options a little bit today, at least give you a broad overview as far as what the concept is, so you know exactly how stock options work. But with that, let's back up a little bit and let's start out the foundation as far as exactly what a stock is. And so what a stock is when a company chooses to go public and they decide to sell part of ownership of their company. So when you buy a stock, you are actually becoming a partial owner of that company. For instance, say I started a company, let's call it Company A, and I was like, hey, I need to raise money either to pay down debt, or I just want to build a little bit of cash reserves. That way I can help grow my company. I'm going to have some other people come and invest in my company, and I'll give them part ownership. And say I only want 10 people to be shareholders with me. So that's what exactly a stock is you're sharing the company and the ownership with that person. So let's say I have 10 shares and I can initially set the price when a company first goes to market and they're like, hey, I want to release shares to the market. It's called an IPO, which stands for Initial Public Offering. This is when they're like, hey, I need help running this company. I want to share the ownership with other people. So I'm going to release it to the public and they could come in and buy the share. And once they buy a share, then they are actually literally part owners of that company. And so there's actually two types of stocks. There's common stock and then there's preferred stock. So the difference between common stock and preferred stock is when you become an owner of the company, then you actually have control of who's on the board. You have control of the CEO, because the people that own the company are the ones that vote on what the company can do. So that's the benefits of being an owner. So if you have a stock, you literally can have a voice as far as how that company operates. So if you have 10 different stockholders, then it's easy and your voice definitely will get heard. But some of these companies have tens, if not hundreds of thousands of shares that are out there. So those shares are very diluted. So if you want a substantial stake in a company, you have to put in a lot of money as far as how much you're going to pay for that stock and what type of ownership you want to have. And so with that, a common stock has the ability to be able to vote on the board, who's on the board. They have control of the company. And then a preferred stock, they actually don't have voting rights. But the reason it's called preferred is because if a company has a little bit of profit and they do what's called dividends, a dividend is where you buy a stock and then the company's like, thank you so much for being an owner. Obviously, people don't make money on stocks until they sell them. So instead of waiting till you have to sell a stock, we're going to actually give you a percentage of our profit as like sometimes on a quarterly basis, sometimes on a monthly basis, just depends on the company, just to say thank you for being a stock owner of our company. And that encourages people, other people to actually buy that stock. And so those are the two types of stocks. There's preferred stock and common stock. So whichever one you choose, and some companies do just one, some companies have both of those types of stocks. So it just depends on the company. So how a stock works is when they do an IPO, they have a set price. And in order to buy a stock, they have different exchanges. An exchange is literally where somebody's like, hey, I want to be a part owner of the company. And you have to call somebody that literally releases a certificate. That's the stock certificate. And to give you proof that you are owner of that company. And so there's different types of exchanges. Like there's the New York Stock Exchange. That's one of the most popular ones here in America. And there's literally a floor in New York where there's people taking these phone calls saying, so-and-so wants to buy this stock for $50. So-and-so wants to buy this stock for $100. And they're literally doing the exchange of the people that want to buy the stock with the people that want to sell their stocks. So obviously, you don't have to hold on to that ownership forever. If somebody's like, hey, I'm done owning this company, I want to sell it. And so that's exactly what a stock exchange does, is it helps with that exchange. So people that want to buy and sell have a medium of exchange, a trustworthy medium. So another medium of exchange, another stock exchange here in America specifically, is the NASDAQ. So the difference between the New York Stock Exchange and the NASDAQ is NASDAQ tends to do tech companies. They tend to do companies that are very progressive. New York Stock Exchange are your traditional companies like Coca-Cola or like just Johnson & Johnson, those types of companies. And there's a lot of companies that are on both of the exchanges. So I highly encourage you to check out both of them. So that's the purpose of a stock exchange, is be like, okay, we have buyers and we have people that want to sell their stock, and they bridge the gap. So how a stock price is set. So let's say, once again, let's go back to my company A, and I initially set the price at $50. And let's say we have a lot of people that's very interested in buying my ownership, part ownership in my company. So if there's a lot of people that want to buy it, but there's not that many people that want to sell their stock, it's simple economics, and it just boils down to supply and demand. Supply and demand. So there's a lot of people that want to buy it, that many people want to sell it. So to entice the people to sell their share, their part ownership of the company, guess what happens to that stock price? So with time, that stock price starts increasing because you have a lot more buyers, but these people don't want to sell. So to entice the people to sell it, the stock price goes up. And so let's say the inverse is related. Let's say you have a lot of people that want to sell their stocks. Say the company isn't doing too well, they're about to go through layoffs, a recession's coming, etc. And they want to sell their stock, but you don't have that many people that want to buy that stock. So to entice the buyers into the market, guess what happens to that stock price? That stock price starts to decrease to make the buyers more interested. It's like when things go on sale. Like when things go on sale at Walmart or Target, you get excited. If it's 30% off, that's when you want to rush in and grab as many as possible because you know it might return back to the original price. That's exactly what happens in the stock market. It's all supply and demand. So the thing that has blown my mind throughout the years about the stock market specifically is that it's all arbitrary. Why is Google worth one price? Why is Tesla worth a different price? Why is Microsoft worth different price? The only reason it's worth those prices is because people are willing to buy or sell at that specific price. So it's all arbitrary. Of course, there's a lot of different dynamics that people analyze, like how profitable are they? And historically, especially in tech companies, that didn't even matter. There's so many tech companies that are out there that are selling at a really high stock price and they're not even profitable yet. But the reason that they're selling at such a high price is because people are anticipating them to be a very valuable company. So like, for instance, imagine if you got in at Netflix when it was at the bottom. Like people are anticipating it to be a billion, $1 trillion company, whatever, like Google. So that's why even if they're not profitable, the stock price still will be high because there's a lot of buyers. They're like, oh my gosh, this company is going to be amazing in the future. And so that raises that stock price. So with that, you have to, so there's other dynamics that go into it. Obviously, the economy affects the price of a stock. We just went through the major recession with COVID. And as you know, when COVID first kicked in, everybody was fearful. The whole world literally shut down, especially here in America, where not many people were able to go out, not many people were able to do the common things that they're used to doing. So naturally, what happened to the stock market? Overall stock, it's not just one particular company, it was almost all the companies. They started to decrease during COVID because everybody's like, nobody could buy anything. There's no exchange of goods or services. And so naturally, they assumed the companies were less valuable because they weren't able to make money. But guess what happened? Boom, they announced the vaccine, things start opening back up. Guess what start happening to the stock market overall? It start going up because they're like, okay, and then we were getting COVID checks from the government. There's a lot more money pumped into the economy just to help businesses survive, help individuals survive, families survive. And so there was a lot of people that had a lot of money. And so guess what? They went out and did. They went and spent those COVID checks on nice things, on necessities. They went out and spent a lot of money. So naturally, what happened to the stock market? It started going up and up and up. So whoever invested in stock during COVID, those were the people that were the big winners because it is up dramatically over the time it was down at the lowest in COVID. So all that to say is it's important to understand these dynamics of supply and demand. If you zoom out on the stock market, get a broad overview as far as why stocks go up, why stocks go down, then that's when you'll start to understand the stock market and specific stuff. So I was actively trading what are called stock options. And let me teach you about a stock option right quick. Most people have never even heard of a stock option. And honestly, I never even heard of a stock option until about 2009. And I actually went to a class. It was a 3-day course that explained exactly what a stock option is. And this is a foreign concept to most people, but I had to explain very concisely, and they used an analogy that made a lot of sense to me, and hopefully this makes a lot of sense to you. So I'm going to use a completely different example. So say somebody owned a house and they wanted to sell that house for $100,000, and they put it out on the market and a buyer came to them. They're like, I'm not sure if I want to buy that house for $100,000, but I want to be the exclusive person to be able to buy that house at $100,000. So the thing about an option is options always expire. So it'd be like, okay, I'm going to pay you $5,000 to reserve the right, but not the obligation to buy the house at $100,000. But I have 30 days to make up my mind. So let's say the 30 days pass and I didn't make up my mind, then the seller can sell that house to anybody else. But for those 30 days, that buyer has the exclusive right to buy that house at $100,000. And so That's an awesome thing. That's what an option is. They have the option to buy that house. Nobody else has the option. So the thing is, let's say Amazon decided to build a facility maybe 5 miles down the road, and the price of the house increased by 50%, all because of the announcement that Amazon was going to be moving in down the road within that 30 days. And so what the seller could do, since they have the option to buy at 100,000, but now the house is worth 150,000, they could do one of two things. So they could either turn in an option and be like, yeah, sign me up. I'm going to buy that house at 100,000 because I know it's worth $150,000 now. And so if they do that, 100,000, they could buy it at 100 and immediately turn around and sell it for 150,000. So guess what? That's a 50% profit on their investment. And that's a pretty good deal, minus the 5,000 they put down for the option. What they put down for the option, they automatically lose that because that they just reserve the right to buy it at that price. So really they make 45% profit. So they could either buy the house immediately and then get the 150,000, or instead of selling the house itself, they can actually sell the option to somebody else versus selling the house itself. They never owned the house. They owned the right to buy it at a specific price. So what that means is, hey, they could go to somebody else, be like, hey, I have the right to buy this house at 100,000. It's worth 150,000. Instead of selling the house itself, they could sell the option to somebody else. And so be like, I paid 5,000 for this option. If you pay me 10,000, you can immediately turn around and make $40,000 just by paying me $10,000. And so guess what? 5,000 to 10,000, that's 100% return on your profit. So that's exactly what a stock option is. You never own the asset itself. You never owned the house in our previous example, but a stock option, you never actually own the stock itself, but you own the right to buy or sell a specific stock at a specific price. As you know, if he would have bought the house itself and turned in the option, then he would have only made about a 50% profit. But since he sold the option to somebody else, he actually made 100% profit off the same deal, even though he never owned it. And so the thing about options is they go up or down a lot more dramatically than the actual asset. And that's the same with stock options. If you buy a stock option and you think it's going to go up, that's what we call a call option. And so you could be like, okay, I'm going to put a call option on, say, Tesla. And Tesla currently is worth $185, and you're going to lock it in there. And you have 30 days to be able to buy the stock or let the option expire. And let's say Tesla goes up to $230. Even though Tesla's still at $230, you still could buy it at $185 and you could instantly make that profit. Or instead of buying the stock itself, you can immediately sell that option to somebody, and it's a lot more valuable because it goes up even more dramatically than what the stock is. Most people aren't even familiar with the concept of stock options. So that's why education is so important. So one of the things you're going to discover, and one of the things I discovered when I was actively trading, I'm currently not actively trading, but when I noticed that stocks are kind of like people. Guess what? It's people that are trading the stocks. They have different personality styles. So what I was encouraged to do, and one of the things I encourage you to do, if you are interested in investing in the stock market, take one company and follow that one company every day for 3 months straight. Like, don't put any money into it. Don't do anything. Just watch it. Watch their ticker symbol. Watch what makes it go up, the stock price go up. Watch what makes the stock price go down. And just follow it. And you're going to learn what the personality style of that stock is. And once you learn that personality style, you're going to feel a lot more comfortably like, oh, wow, we're about to hit the summer months, and we know retail kind of goes down a little bit during the summers, but then boom, fall hits and everybody's buying gifts for Christmas. They're buying gifts for Thanksgiving. They're about to see their family, right? So retail actually increases a little bit towards the fall and the winter. And if you know that, and you know that about your specific company, then you know when to get in and out of that company as far as their price is concerned. Because obviously the goal of the stock market is to make a profit. And that's the goal of the CEO of that company. That's the goal of the board of directors for those companies is to make the shareholders profit, to make the owners profit. Because the more profit they make their shareholders, the more money people invest into that company. So those are just general overviews on the stock market. If you have any question on the stock market, definitely feel free to type in the chat. Like I said, I'm not an expert when it comes to stocks, but I just wanted to give you a broad overview on stocks and stock options. We do have one question. It says, Darnald, how do we start investing in the stock for beginners? That's an amazing question, Natalia, because there's different exchanges out there, different ways to get in the stock market. One of the most convenient ways is your phone. There's so many apps and brokerages that you could use just via your phone that you don't even have to pay money for. So one of the ones that's a little controversial, but I personally use it, is Robinhood. Robinhood is an app. You literally put all your credentials. They do a lot of background check to make sure you are who you say you are, that you're not scamming anybody or whatnot. And so once you put all your credentials, you connect your bank account, then immediately you could transfer money from your bank account straight to Robinhood, and you could buy stocks straight through the Robinhood app. And the nice part, one of the things that people don't realize when it comes to buying stocks is, like, for instance, let me share my screen with you guys. Share my screen. So the thing is, most people think, for instance, Tesla right now is trading for $185.77. And they're like, Darnald, I don't have $185 right now just sitting around to buy Tesla. So the nice part about Robinhood is you can actually buy what's called partial shares. Let's say you only have $5 to put towards Robinhood. Guess what? You could take those $5 and buy part of Tesla. And if Tesla goes up 10%, your money goes up 10%. If Tesla drops 10%, guess what? Your money drops 10% on those $5. So you actually have a partial share. So there's ways to invest your money where you don't have to have a lot of money. And that's the beautiful part about how the stock market works nowadays. So there's TD Ameritrade. You could go through Bank America. You could go through Merrill Lynch. There's so many different companies out there where you could open a brokerage account where you could actually buy or sell stocks and stock options for that matter. Robinhood does have the capability, once you upgrade your skill level, to be able to buy stock options also on Robinhood. That's another little known fact that is really amazing. So that was a really, really great question, Natalia. Thank you for asking it. So if you have any other questions, feel free to type in the chat and I'll be happy to answer the best I can. My encouragement for you is just to know that the stock market is risky. Like, obviously you have the potential to make money, but guess what? You also have the potential to lose money too. Historically, the stock market has been a good investment because historically it's gone up 8 to 10% over time. And obviously the key to the stock market is not trying to time the stock market, but it's time in the stock market. One of the things that's a great vehicle for a lot of people, it's not for everybody, but obviously talk to your consultant, you're definitely your tax consultant, but also obviously your brokerage consultant about what makes the most sense for you in your risk level, because there's different risk factors. But there's a thing called index fund. And what an index fund is what they do is they buy a whole bunch of different stocks and put it in a basket for you, and you can invest in that specific index fund. And as those stocks either grow or shrink, then you'll make money or lose money. But historically, over time, index funds have been the best bet. So it's time in the market. So you got to have a time and be consistent in the market. So I just wanted to jump on real quick and share that with you guys, because the stock market is something that is like, it's scary for a lot of people, because if you don't know, then it's like, which stock do I choose? How do I invest? What exactly is a stock? So hopefully I answered those questions for you. And hopefully this is something that will help encourage you, if not to do more research, dive a little bit deeper, consult somebody that is an expert in stocks, because it is something that could literally be the difference between building wealth and not building wealth for you and your family. And that's the purpose of this show. It's all about education. It's all about knowledge, because the more you know, the more you could do better. right? So I appreciate you guys for tuning in. If you got any value out of today, smash that like button. If you're on YouTube, subscribe to Finlit Live. I appreciate you for tuning in. I appreciate you for watching to the end of the show, and I appreciate you guys for getting lit.